did rally a bit this week, but commodity markets have taken a beating lately, largely because of concerns over weaker global demand and the U.S. dollar. Well, to give us his view on where those markets are headed from here is longtime commodities trader and consultant Kevin Kerr. Kevin started the trading pits of the New York Cotton and U.S. Dollar Index back in 1989, actually owned a seat by the age of 22. He is currently CEO of Kerr Trading International with offices in New York and Wilton. Kevin, good to have you on the program. I should say also you have your book, A Maniac Commodities Trader's Guide to Making a Fortune. That's what we want.
That's right, and that's not me. That's not my pick.
I was going to say, you're very limber. Anyway, how are you?
I'm terrific. I'm terrific. And you know, the volatility has been insane. We have to admit that. I mean, you know, you look at the screen 1 minute and gold is up $20. Next minute it's down 30. And this is the kind of volatility we have never seen in these markets before.
Volatility, though, provides for opportunity. I mean,
it absolutely does.
For you as a trader, this is where you really make your money, right?
That's right. As you pointed out, I've been trading for over 20 years, and there was about a 10-year stretch there where we had no volatility, and that's horrific for our business because we want that movement. We want the movement in prices. I would say that a lot of the commodities have moved, especially when they were at their highs, especially the grain markets and the soft commodities and the energies, of course, moved to levels that are pretty much unprecedented so quickly, so far, so fast.
You mean oil at 147?
Oil at 147, oil at 126. I'm on record you know, all over the place saying that when oil got to 126, there was no basis for it. At that point, you know, we really needed to see a lot of these commodities ratchet up to where they should be adjusted for inflation, and we got that. But then we exceeded that. And the reason we exceeded that is we had a lot of hedge fund money coming in, a lot of new speculative money coming in, and it pushed it and it pushed it and it pushed it. And we finally got to a breaking point, and now, of course, we're getting the swing back reverse to what I feel is too far to the downside on many of these commodities. Somewhere in the middle, we're going to find the range where we're supposed to be. And I think that's what T-Boone is talking about.
Yeah, talking about oil going back up. All right, where is the range that oil should be?
Well, I believe oil price should probably be more between 85 and 105 right now. Now, this is, you know, a lot of guesswork in here. It's really based on demand. It's going to be based on how fast we can get credit back into the system and how fast the Chinese engine can get running again and our own economy. So these are a lot of ifs. So, you know, I think, though, that we can all admit there's still strong demand for driving and for heating our homes and all the things that we have to do. And a $60 price for crude is undervalued, even based on inflation.
All right, so how do you think that this will affect, let's say oil goes back up to 105. So you think that there is hope then for alternative energy stocks as well? Let's say solar, for example.
Sure. You know, this is a double-edged sword. It's terrific for all of us to be able to go to the pump now and have it be below $3. I love it just like everybody else. But the problem is when those prices come down, the incentives to go after alternatives, to do more drilling, to do offshore exploration, solar, all these things, they all go out the window. Because at a price of $66, it's just not worth it for investors to put that money towards that, and they're not going to. So it is a double-edged sword. While we enjoy these lower prices, the problem is we're not solving the problem that caused it in the first place, and we're going to go right back through the cycle. All
right, well, what about gold? Gold has had these huge swings. I mean, gold is known to be very volatile.
Yes.
But what do you see as the future for gold, especially in lieu of the dollar, how much money the Fed has been printing? Eventually, we're going to look at some serious inflation out there.
Absolutely. I am not a gold bug, as they call them, people that think the gold's going to $5,000 and that you should bury it under your yard. That isn't the outlook I have. Gold is an inflation indicator, and we have inflation. We have inflation worldwide. We saw gold get above $1,000. I predicted that when it was at about $500 or $600 that we would get there, and we did. And it's now pulled back again. Another situation where we had a lot of hot money come in, the price got too far too fast, and on the retail level it became impossible for a lot of these countries that really rely on gold as more than just money. As a real value, a store of value, to be able to afford it. And so we've seen that pull back too. My belief for gold is in the next couple of years you will continue to see it ratchet higher. Silver might even move quicker, and you'll see silver move faster. It's used industrially and as a precious metal.
But we've seen copper take a real beating.
Well, copper's an industrial metal, and of course with the slowdown in construction, with this huge housing debacle that we have, copper's going to be the one that takes the longest to recover, I believe.
What about grains? People at home are saying, why grains, Becky? Why are you talking about, say, corn, for example? But it's tied to ethanol. And the future of ethanol.
Absolutely. Grains is one of my specialties, and I actually go out to the farms every year and I walk the fields and I've talked to farmers, and this is another situation where we had prices that were undervalued for many years in things like corn and wheat and soybeans. And suddenly, you know, we started to see a lot of money pour into it because of the biofuels. But what happened is it got a little ahead of itself. We started seeing these ethanol plants being built for tons and tons of money. The infrastructure alone to run one of these plants, the water that's needed alone is just absurd. And the actual value of the power that comes from them is minimal. So we really have to rethink that. I think what's going to happen is we're going to have to shift gears, turn those ethanol plants into something that's usable, which may be ethanol from something like sugar, which is much more efficient, reduce the tariff on sugar. Hopefully the new president, whoever that might be, will do that, immediately take that 53-cent tariff away, and turn those plants into something that can actually produce ethanol for something that's useful. Also soybeans and soybean oil.
All right, a lot to think about, big changes, and who knows, we tape on Thursday afternoons, so it could be a very different picture.
Could be a whole different world by Saturday.
That's right. Kevin, good to have you in the program, a maniac commodity trader's guide to making a fortune. And that's all for this week. We'll see you next week on 12 on the Money. I'm Rebecca Saran.